And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And welcome to my podcast. I hope you had a great weekend. It was a long weekend. We'll see what happens with Iran, see if this thing will last or not. But, you know, it's interesting. All the years that I've been trading, 50 years, a little more than that, nobody really understands how rates come about. Everyone thinks that you get the Fed sitting around this boardroom with brains on Wall Street, and they're really chopping through numbers and computers and AI and how do we figure this rate. Yeah, it's done by a guess. Think about that, a guess. They put your financial health, your small business, its health, individual health on a guess, just a guess. Most people won't believe that. What happened last week when we had on June 17th, the chair came out with what they call the dot plot. Nobody ever heard of the dot plot. It comes out 4 times a year. And it's a guess what rates are going to do. And what happened is, normally there's 18 people who participate in the Fed. And the 18 people get together and they all guess at what they think the rates are going to be going forward. They're going to move them higher or lower. In the same conditions that we have today, economic conditions we have today, every time that they guessed, thered be maybe 2 out of 18, most 3 out of 18 that would say rates are going to go higher. Let's say 3 out of 18. Well, what happened on Friday, it was 9 out of 18. What are you, nuts? And that's when the 2-year Treasury exploded and went up 16 basis points, all on a guess. That's right. Normally, it's always 2 to 3 members of 18, but it was 9 of 18. A guess. So how is it possible that the most important rate in America, the one that decides whether your family survives or your small business survives, all based on a guess? That's nuts. So it's traders, how it starts with these rates, how they come up, how these rates come to the Fed, or come about, I should say. It starts with traders. Traders guess what the Fed will do. Now get this. This is what determines if you own a small business and you're struggling and it's hard to meet inventory and you're trying to get a line of credit from your bank so you can borrow more inventory, borrow more inventory and pay your payroll, or borrow money for your accounts receivable because it's slow in collecting. The rate you pay is a guess. And how many people in business that they dread looking at that rate? They get their notices, right? Rates up again, it's up again. It kills you. Rates can kill you. So what happens is the traders guess what the Fed will do. That's the first thing. That's how it all starts. They just guess. The traders. Not Congress, not Wall Street, not the board of directors of Goldman Sachs. Traders. They guess. Now the traders, again, once they guess, and let's say they guess it's going to go up 2%, 3%, whatever, that's when the 2-year Treasury moves. This is what people don't get about the market. The 2-year Treasury moves, but it doesn't move its rate until first the traders guess. Then the 2-year Treasury, and why it's the most important, there's 5 reasons why it's the most important Treasury in the United States. We'll get through those in a moment. So traders, they make their guess. 2-year Treasury starts to move, and the banks react to the move from the 2-year Treasury. It's that simple. Now, only then does the Fed react to that 2-year yield. And then the Fed starts to move its rates. Now, by the time this happens, Main Street is already feeling the pain. Because remember, if you go back, the 2-year Treasury already started to move back further in time. So by the time they decide what the rate's going to be, the guess, it's damage has already been created. Now, what happened last week is a reaction to that guess. When the traders said that, oh, yields are going to go down and we're going to see cuts. And then the Fed turns around and reacts and says, oh, no. No, we're not going to see cuts. Not going to happen. It's just not going to, we're going to see rates. And that's when the 2-year Treasury takes off. Remember, the 2-year Treasury was designed to act when there is some sort of movement or some sort of shock or surprise. And that's what happened. And that 2-year went up 15 basis points. We went up to like 4.75. It was crazy. But the market didn't agree. And then all of a sudden, as you know, within one day, it started to come back down again, started to contract. But think about the pain that we go through, you and I and small business individuals every day, the financial pressures every day, because of cost of money, credit cards. And look at the credit cards, 22%. Business loans, credit lines that businesses need, auto financing, inventory financing, payroll financing. You can go on and on, all by a guess. That's insane. And that can break a household. That can break a business. That can put you into bankruptcy. Small businesses this year are up by 67% because of a guess. So the next time you think, when you hear rates are up or rates are down, it was a guess. That's it. That's the little thought that's in it. And who guesses? The traders. Talk about, putting a dog in a chicken coop. So, now, because of this system, the middle class has suffered more than anybody else. 61% of the middle class is no longer middle class. Okay, we dropped from 61% of Americans being middle class, we dropped down to like 45% being middle class. Isn't that terrible? So the middle class is really is collapsing, is what's happening. So, and the middle class owns far less wealth relative to the top 10% than it did even before 10 years ago, a decade ago. But remember, the reason for that, and why if you're middle class and you're losing ground, is because of everything is based on this guess in the 2-year. Now, the 2-year is very, very important, okay? And people don't understand the importance of the 2-year Treasury. The 2-year Treasury was put in place, okay? Think with the 2-year Treasury, it was put in place for any kind of, exaggeration or quick move or whatever. I mean, in other words, the 2-year Treasury is there to pick up on anything that's unusual, okay? Expectations. It's supposed to pick up on expectations that go on haywire. And that's what it does. So, but nobody ever thinks about the 2-year Treasury. They always think about the 10-year Treasury. Okay, never think about. They always think, of course, not only that, but they always think about the Fed rate all the time. But it's the 2-year Treasury that really has the most power, and it has again controls everything. Controls everything. It's the most important yield. It's the Fed expectation gauge is what it is, and it acts. And when it acts, it can be brutal. It's the market's forecast of what interest rates are going to be 2 years down the road, and that forecast comes from the guess of the traders. I mean, that's crazy, isn't it? You'd think people were sitting around in this big conference room and their desk sleeves rolled up and they've got their computers. No, that's how simple it is. And so it tells us what the yields are going to be or interest rates are going to be for the next 2 years. And it's expecting no cuts. No cuts for the next 2 years. Everybody thought, oh, we're going to get cuts, Trump's going to get cuts. No. We're finding out now they're not planning any cuts for the next 2 years. So that's where it gets a little scary. And it's the most important yield, Treasury yield, because it does affect everything we touch that we have to borrow money. It does everything, from small business loans to auto loans. It affects everything. And there's no thought that goes in it. And that 2-year Treasury rate, okay, that's the one that monitors it. And that's the one that reacts to it. So last week when they came in and they said, well, we think rates are going to go, everybody's thought rates are going to go down. Traders, rates are going to go down. And then they said, no, we don't agree with you. We don't agree with you. The Fed says, no, we think rates are going to go higher. And that's when everything exploded. So so if you think of the 2-year Treasury, it's the most important because it's the Fed's expectation guide, but it's also the truth serum. You know, it's just like with yields. Yields will always tell you, if you look at the yields, you'll never get hurt with a crash or correction, because once it reaches that 4.5, it will always tell you that the possibility of a crash or severe correction is on the horizon. It could happen any time. And then when you look at IWM, the small mid-cap stocks, that tells you if it's telling the truth. If the yields are telling you the truth, that there could be a collapse in the market or whatever, because IWM will turn red. Always does, always have. Because see, the reason IWM is important is because it's not disrupted, it's not tied to tech stocks. It's not tied to it, so there's no disruption, there's no connection. IWM is small, mid-cap stocks. So when that guy turns red on your chart and the S&P stays green and the Dow stays green, it means the yields have already identified we're in trouble, that we got a high probability of a correction or crash, and when it turns red, that's the confirmation. And in 50 years, it's never been wrong. Never been wrong. So a lot of people look at the wrong thing when they're trying. What's the market going to do? What do you think? You're going to have a crash rate? It's simple. Just go every day, look at IWM, and look at the S&P, and look at the NASDAQ. And if IWM is red, and the NASDAQ and S&P are green, you got a problem. But if they turn green as well, you got a real problem. So again, this going back to this 2-year and how important it is to watch the 2 year. You got to learn to watch that 2 year. And it's the same thing that traders don't do. Everybody is taught, okay, these stock groups, if yields go up, you buy these stock groups. If yields go down, you buy these stock groups. Well, you can lose a lot of money doing that. Now, I mean, it's a good gauge, no question about it. But many times, like for a couple of stocks that we're in, we're told that, the yields, if they're high, these stocks should be collapsing, going down, and stay away from them. But these stocks are going up. and we're making a lot of money on these stocks. They're the four stocks that have to do with making business machines. I mean, making the machine that makes the what do we call them? I can't think of what we call them now. But it's what is it? What are they? Oh yeah, that's right. The chips. I'm sorry, the chips. It's the machine. They make a machine that makes the chips. There's four companies that make that machine, and that company keeps going up. And right now, with high yields, we're being told don't buy it because the yields are going up, and that's bad for these stocks. But they're still going up. So what do? That's called relative strength. So again, there's a lot of thing in trading and investing that people just don't look at. They just don't know. Wall Street doesn't tell them. And you'd lose a lot less money if you only knew these things. And that's why we've been here to help you for 25 years. So I hope this helped you somewhat. Okay, but that 2-year Treasury, watch that like a hawk. It'll tell you everything you need to know about where rates are going. So we'll see you again. Thank you for listening to my podcast. We'll see you tomorrow at the same time.
Are you nuts?